Thanks, Jim. Appreciate the intro. And I spent about 1 year in Denver and definitely enjoyed my time visiting the group and meeting everyone. Um, for both kind of personal reasons and just kind of felt like essentially half my family's here in San Diego, and Denver was a fun adventure. But my long term home is San Diego. I'll definitely still be visiting out and hopefully can still swing by the group occasionally, and especially for the summer event, and bring my bass out and jam one time for everyone. But as for business, when I first joined the group, you guys will probably remember me. The name of my company was House Lending. Nothing actually changed from my perspective. Essentially, the parent company, Rock 360, acquired Finance of America Commercial, and all of the house lending people, we were rebranded as Finance of America Commercial. Essentially, Finance of America Commercial has been around for quite a long time. They have a big name in the industry in terms of going to conferences and have a big nationwide presence already. So that was part of the game plan for why Rock 360 acquired them. And essentially, I was just rebranded. So the loan programs are the same. The underwriting process is the same. Nothing has really changed except for my email signature and obviously our marketing brochures and all that fun stuff. But anyways, the presentation today is kind of giving you a look between essentially kind of what I do on a day-to-day basis when I'm talking to both borrowers and brokers in terms of what information do I need to pre-screen a loan scenario. And we kind of focus on residential investment properties. So no home loans. These are all either rehab, fix and flips, ground up construction, or DSCR rentals. And we have some multifamily programs as well. But none of our programs require tax returns. There's no DTI ratios. It's really more about screening the property for its ARV on a rehab loan to make sure there's enough profit in the deal. And then on the DSCR rental side, making sure that the rental income covers the primary expenses on the property. So we'll start off with a kind of a fix and flip scenario. Basically, borrowers buying the property, going to be putting some rehab into the property with the intent to sell the property. And essentially this pre-screen questionnaire are the questions that I will ask to either a mortgage broker or a borrower directly in order for me to estimate what LTV, what leverage is available, and also estimate the pricing as well. So starting off for a kind of just classic fix and flip scenario, the first question we're going to ask is how many deals has the borrower completed in the last 3 years? So for our programs, experience is the biggest factor in determining the available leverage. So first-time investors start at 70% of purchase price and 100% of rehab funds. And then our most experienced investors, experience level 5, once a borrower's completed at least 5 deals in the last 2 years, we can do up to 85% of purchase price or even 90% in certain scenarios and 100% of rehab budget. And then obviously going from a first timer to a experienced 5, the leverage increases from 70 to 75 to 80, et cetera, all the way up to either 85 or 90% of the purchase price. Next question, approximate mid-credit score. The credit score doesn't affect the leverage explicitly, but it will affect the interest reserve requirements. So all borrowers are required to bring 1 month of interest payments to closing. For borrowers with lower credit scores, underwriting may require 3 or 6 months. If the score is between, around 650 or so, if the score is below 620, that's going to be a mandatory 12 months of interest required at closing. Those monies will get refunded. So if the borrower, finishes the project in month 3 and sells the project in month 4, and they put 12 months of interest reserve at closing, then they'll get refunded the 8 months back. So essentially it's prepaid interest that will get refunded when the property is sold if it's required. Typically, if 680 credit or above, you don't have to worry about that. Next question, address or location of the subject property. Sorry, Jim, I'm still on just going through the first. There we go. So address subject property, we typically, we can lend in more rural or remote areas, but the leverage is going to be cut to 60 or 65% of purchase. So that's why I like to know that question up front. If you're dealing with major metropolitan areas, and essentially if you think the comps are going to be within 2.5 miles of the subject property, that's kind of the sniff test that underwriters are looking for to be comfortable offering the higher leverage. Then it's not going to be an issue. Purchase price, rehab budget, estimated ARV, those numbers are all needed to calculate the profit in the deal. As a firm, we believe that if the deal is penciling profitably, the borrower is making money, the lender is making money, everyone involved in the transaction is getting their cut, then it's going to lead to lower issues and lower default rates. And that's a big part of our screening. If essentially we need to see that the borrower is making at least $15,000 in profit and 30% cash on cash ROI. Those are the two metrics that underwriters are always looking for on these fix and flip deals to make sure there's enough profit in the deal. And when a borrower gives me these numbers, if I run the numbers and I'm seeing that it's only, flat P&L or showing, negative, not penciling correctly, then there's really no reason to order the appraisal. I don't want to be wasting the borrower's time because it's not going to get through underwriting if it's not showing some type of profit. And then the last question, is the borrower a licensed GC, real estate agent, or other construction industry professional? That can help increase the initial advance. So if the borrower is a real estate agent, we can start at 75% of purchase and 100% of rehab funds, even if they haven't completed any deals. If the borrower is a licensed GC, we can start at 80, 100. And then same idea, engineers, licensed architects, they all get a bump in the leverage, even if they haven't completed any previous deals. The last part of this slide is regarding the BRRRR strategy. So if the borrower is intending on keeping the property as a rental and not selling it, then we're going to have to get a couple of additional data points to make sure that the property is still cash flowing from a rental perspective. So especially on multi-unit properties, these programs are for 1 to 4 unit properties. A lot of times when borrowers are rehabbing duplexes, triplexes, or quadplexes, especially on a quadplex, right? You may not get a lot of bang for your buck in terms of the ARV on the property for a quadplex, but it's going to cash flow really well. So if it cash flows really well and the DSCR is strong, we may be able to still pencil out good leverage on the rehab loan because it's penciling out strongly as a rental exit. So we're going to ask for the rental income, estimated taxes, and insurance, and with and HOAs if applicable, and those additional data points will help to show that it's a strong rental property. Okay, now we're ready for the next slide. Thank you, Jim. Okay, so next loan program is our ground up construction program. This is one of the harder programs to qualify for from an experience perspective. So underwriting wants to see at least 3 previous ground up deals completed, or it could be, let's say, 1 or 2 ground up deals plus a number of heavy gut rehabs. So the underwriting really wants to see similar previous ground up experience in terms of the size of the construction budget and also the location of the property in order to qualify for one of our ground up loans. And it's a similar evaluation process in terms of the credit score, asking about the land purchase price, construction budget, ARV. All of those data points are needed to make sure that the deal is still penciling profitably from a flip perspective. And then very similar, especially with ARV softening here in the last year or so and interest rates going up, there are a lot of builders now that are doing the build to rent strategy and kind of just holding on to properties and keeping them as rentals until, the market goes back up and they think they can sell it, for a higher profit. So if that's the case and the builder is intending on doing a build to rent project, then it's the same idea. We're going to ask for what do you think the monthly rental income is, estimated taxes, insurance, HOAs, et cetera. And that will help to show that it's a profit. It still can be a strong rental property from a DSCR perspective. And now we can go on to the last category, last slide here, which is talking more specifically about our DSCR rentals. So for a single property rental, The first question we're going to ask is, how many rentals does the borrower currently own or have owned in the last 2 years? The experience score isn't quite as important, I would say, on DSCR rentals versus kind of the bridge, kind of ground up construction and rehab loans. The interest rate will move a handful of basis points as a borrower shows they have more rental experience, but it doesn't explicitly affect the leverage. The credit score of the borrower on DSCR rentals, that does explicitly affect the available leverage. Our minimum credit score is 660. And for 660 to 679 credit, you can only get 60 LTV on a cash out and 65 on a purchase. For borrowers that have at least 740 credit, our maximum leverage is 80% of purchase price on a purchase or rate term refi, and up to 75 LTV on a cash out. So the credit score, I should say, is much more important on a DSCR rental versus a bridge loan. Next question, address of subject property. For permanent rental loans, it's much tougher to get a rural or remote property through the system. Maybe at like 50 LTV or lower, can we consider like a rental loan? It's kind of the same idea with the comps. So for a rental loan, underwriting really wants to see both sales comps and rental comps within 2.5 miles of the subject property. So when I get a DSCR rental scenario, one of the first things I'll do is I'll go on Zillow, and instead of looking at for sale, I'll switch it to for rent. And I want to make sure that there's a good amount of purple dots for other similar rentals showing in the area, hopefully within a few miles of the subject property, because if not, the leverage is going to get cut to 65 LTV. Even if the borrower has a great credit score and it cash flows really well, if those rental comps are too far away from the subject property, that's going to be either a cut in leverage, or if the appraiser marks the property as rural or remote, that also we can't proceed. So I try to do as much as possible on the pre-screen, so that way we're not ordering appraisals on rural or remote properties on DSCRs, because it's just not going to get through the system. And then as for the actual data points, your monthly rental income, taxes, insurance, HOAs, and just to go through the basic DSCR calculation, essentially it's your rental income divided by PITIA. So you'll hear that term that lenders say that a lot. So PI, the first PI, that's principal and interest. That's your mortgage payment. T is taxes. I is insurance. A is HOAs. So for example, let's say you have a single family property that's bringing in $1,200 a month in rent. You have $800 in monthly taxes, $100 in monthly insurance, $100 in HOAs. You have $1,000 in expenses, $1,200 in monthly rental income. That's a ratio of 1.2. That's, the main thing that the underwriting is looking for on these deals is, what's the DSCR? What's the DSCR? That's what they're asking. What's the ratio of the rents to the expenses on the property? Our minimum DSCR is 1.1. So essentially the rents need to cover the expenses with at least a 10% cushion is kind of the simple way to say it. And then for the highest leverage, in order to get 80% of purchase price or 100% of rehab funds, 80% of purchase or 75 LTV on a cash out, the DSCR needs to be 1.20. And then the very last bullet point on portfolios, we can do large portfolio loans. So we have an institutional investors that use our DSCR rentals, and we do very large there's really no unit limit to the number of properties. So it could be a 20, 30, 40, 50, multiple hundred unit portfolio. And as long as the DSCR is good and all the properties kind of are conforming to the program, you can throw in as many properties in the portfolio as needed. And I think that's about it, Jim. So a nice little summary of kind of all of our programs and kind of how I look at things and the questions that I ask day to day. And hopefully that kind of little behind the scenes look at what I do all day, every day, kind of gives you a better sense of how we look at the industry, or how we look at loan scenarios from a private lender, hard money lender type perspective.
Thank you, Daniel. Anybody got a question for him? Oh, hands are going up everywhere, Daniel. All right, I think Drew, you were quick to the draw.
Hey Dan, how's it going?
I'm doing well. How are you?
Doing good, man. Hey, what are your rates?
Sure. So fix and flips, I would say generally are kind of in the 10 to 12% interest rate range. These are 12-month terms, no prepayment penalties, interest only payments. DSCR rentals, the interest rate is kind of most impacted by the leverage and the loan structure. Obviously, a 50 LTV loan is going to be a lower rate than a 75 LTV cash out. The general range, I would say, call it like low sevens for lower LTVs, up to kind of high sevens, low eights, depending on the loan structure. We do have some kind of shorter prepayment penalty options. We have partial interest only options. So if you get really quirky with your loan structure, you know, you maybe at a mid eights for a 1 year prepay, right? If you really don't want a 3 year or a 5 year prepay. But so I'd say kind of low sevens to eights on the DSCR rentals and 10 to 12 on the bridge loans.
Yeah, thank you. Well, next year I was surprised to hear you move.
Drew says he misses you, brother. You gotta come back for our party next year.
Yeah, no, I got to go back for a summer party for sure.
One of our newer members, Mr. Thomas, you got a question there?
You got a question. I'm in the process of refinancing a bird project in Colorado Springs.
Mhm.
FDR. It's been about 6 months now. I'm starting to report this week. My question to you is that do you count in place these as a rental income, or do you still do market rent? So for example, you know, my rent is 2,300.
Okay.
Market rate might be, it just depends, you know, different lenders have different requirements, so what do you go with it?
Sure. Good question. So I didn't catch 100% what you said, but I believe you're asking about market rents versus actual rents.
Yes.
So yes, so underwriting is going to use the lower of your actual leases in place and the market rent survey in the appraisal. So for DSCR rental loans, the appraiser is asked to calculate both an as-is value and a market rent survey. So that's, and I kind of do that as well in my pre-screen. So that's why, you know, when I mentioned going on Zillow and checking the comps, right? If someone tells me that I have a single family house and I rent it out for $7,000 a month and I'm getting 75 LTV, no problem. But then I go on Zillow and I see, you know, it's only houses are only ready for 2,500 a month. Obviously, I got to do a reality check for that person. But yes, to answer your question, it's the lower of the two.
All right, Miss Christina. I thought you with a mouthful, didn't I?
What is DSCR?
What is DSCR, Daniel?
DSCR is debt service coverage ratio. So essentially it's kind of that simple formula that I mentioned where you're taking the rental income of the property and dividing it by the primary expenses on a rental property, which is your mortgage payment, i.e. principal and interest, PI, T, taxes, I, insurance, and A, HOAs. So rental income divided by PITIA, that's the DSCR formula.
There's no CapEx, there's no vacancy, there's none of that.
Great question. For single property rentals, we don't take that into account. Once you get into larger portfolios and once you get into bigger multifamily, so that DSCR equation that I gave you is a gross rents over PITIA, which is used for single properties and portfolio loans under 2 million and for 1 to 4 unit properties. Once you get to 5+ unit properties and 1 to 4 unit portfolios with loan amounts over 2 million, then yes, it switches to a net income over kind of, you know, all expenses, including CapEx, vacancy. So yes, we have kind of boilerplate expenses that underwriting kind of uses. And I have, you know, kind of our calculator and, you know, when I have these loan scenarios that are bigger, yes, I'll kind of switch to my net cash flow expense sheet. Because yes, they definitely chops into the to the DSCR when you start chucking in all those extra expenses.
Anybody else? Miss Nicole?
You offer 40-year term loans?
No, all of our DSCR loans are amortized over 30 years. We do have adjustable rate mortgages, so 5, 7, and 10-year ARMs. But those are all amortized over 30. And then same idea, we also have partial interest only. We have 5, 7, and 10-year partial IO loans. So essentially the first 5, 7, or 10 years are interest only. And then the back 25, 23, or 20 years are fully amortizing.
And when you take rental income comps from like Airbnb, like AirDNA or MaxPfizer for Airbnbs?
Good question. So we unfortunately do not underwrite to any short-term income. So we really don't have any programs for kind of like Airbnbs or Verbos. It's all long-term leases.